minus the liabilities are done. So also called net worth or capital. All right, so under the business entity, the owner of a business may have business assets and liabilities as well as non-business assets and liabilities. So non-business assets and liabilities are not included in the business entity's accounting. So this is something you have to keep in mind. The owner's going to have his own personal wealth. That's why that's separate than the business. He's got to decide, or she's got to decide, what are they contributing of that wealth into the business. And it's easier to do by him or her either transferring the title of the property. If it's real estate that they want to say is what they're using in the business, then he has to transfer the title to the name of the business, so it's clear. In the example of his bank accounts, he wants to write a check and use the check that he wants to put into the business into a new checking account in the name of the business, so that if he needs money for his personal use, he takes it out of his personal checking account. And any expenses or needs by the business should come out of the business checking account. So that way, they can properly track what's going on in the business. Okay? And if the owner invests, those assets are now, only if he says it's going to belong to the business, it can now be classified as a business asset. But until the owner does that, it's not non-business and it shouldn't be part of your books. So, broader view. Assets and cost of products you buy. Next time you buy something, think of all the assets the company needs to produce that product. The product comes from a capital-intensive industry, one that requires heavy investments in assets. The company must price the product high enough to cover the cost of using the assets. So it gives you an example of AT&T. So those of you working in Docomo, AT&T is another telecommunications firm. They recently reported the cost of property, plant, and equipment used for operating purposes came to over $274 billion. So if you ever look at the financials for Docomo, you probably have a lot of assets. All right. So here's the accounting equation. The left side is our assets. The right side is our liabilities plus owner's equity. Okay. So in this example, let's try to figure out what's the missing item. So it says if a business has total assets of $60,400 and total liabilities of $60,400, what is the owner's equity? In this first example, 0, right? Because your assets equal your liabilities. But once he pays off his debt, what's going to happen now? So this will zero out. It's going to decrease, and then whatever the balance is will now belong in owner's equity. So it says here that he paid down $5,400 worth of his liabilities. Okay? So when that happens, normally when someone pays off their debt, they're going to use cash from that asset account cash. So your asset will decrease by that amount. So your owner's equity now will change, because now you pay down the debt, your owner's equity can be $55,000. Okay. All right, so we're going to see some business transactions, and with those business transactions, a business transaction is an economic event that takes place in your business. So this is my example where I said I'm the owner and I go to lunch and I give the receipt to Lana and say, here's a business transaction, record that on our books, right? So that event really has to have a direct impact to the business, not just that I went to lunch and want to pass off my lunch as a business expense. Okay, and it usually requires an exchange with an outside entity. The business transactions that you're going to see are all in dollars. Okay, the monetary unit used in our book. And every business transaction affects at least 2 accounts, okay? And it affects the accounting equation based on those specific accounts. So an account is a separate record used to summarize changes in each asset, liability, and owner's equity of a business. So these accounts all have account names. So on the assets, we talked about cash, buildings, all of those are account names. So when you're gonna analyze a business transaction, you wanna ask yourself 3 questions. First one is what happened? The next one is what accounts are affected? And then how does this affect the accounting equation? So when we say what happened, you have to understand the transaction that took place. Does it really affect the business? So that's what a lot of us should do. And then once you say that yes, that receipt is for the business, then you have to decide what are the 2 accounts, or sometimes more than 2, that are affected by that transaction. So when you look at those accounts, is it affecting only asset accounts, or is it affecting both an asset and a liability, or an asset and the owner's equity, or just liability and owner's equity? How is this affecting my accounting equation? So which accounts are increasing or decreasing? And once you've determined that, determine, is your accounting equation still balanced? Because it has to be balanced after you put in your transaction. So let's see some examples. So we have Rohan's campus delivery. So Rohan is the owner, and he starts off his business by investing $2,000 in the business. So what happened? The owner invested $2,000 in the business. What accounts are affected? Assets and owner's equity. What particular asset account? Cash. So your cash is $2,000 increasing. And what about the other side? The owner's equity increasing. Okay, so owner's equity has a lot of different accounts. So what are some of the accounts that you would see in owner's equity? So we have the capital account of the owner. The owner also has a withdrawal account. So when the owner wants money from the business, there's a owner drawing account. And within the owner's equity, this is where we would record income that the business generates, because that increases the owner's wealth in the business. And then expenses decrease the owner's wealth. So here's the example. These are your 2 accounts that are affected, right? And we know cash is an asset, and we know capital is owner's equity. So your cash is increasing, your capital is also increasing. Is my accounting equation going to be balanced? Yes, right? Because your asset is going up, and your owner's equity capital is also going up. So we're good. Transaction 1 makes sense. Here's another one. You're buying equipment, delivery equipment for cash, $1,200. So another person besides Alana who wants to volunteer next. Let me find my sign-in sheet. Okay. Gotta send around my sign-in sheet. Okay, I don't know where my sign-in sheet is. I'm gonna look for it a little bit. So who's our volunteer? The next person in her row. What's your name?
Maritas.
Okay, Maritas. What is the 2 accounts that are affected?
It's the asset.
What type of asset?
Equipment.
Equipment, yes.
There's also the quiz, which is negative 1,000 other assets.
The cash. So in this example, everything is happening on the asset side. One is cash is decreasing, and you have another asset increasing, which is the delivery equipment. So that's correct, right? Delivery equipment and cash. Okay, so one's increasing and one's decreasing. So will this make my accounting equation still balanced? Yes, right? Because everything is on the same side. One's a plus and one's a minus, equal amounts. So yes. All right. So your assets still remain the same. So proving your accounting equation. So in every transaction, you may want to prove that you're still balanced. So your assets, this is what happened in those two transactions. Your assets total 2,000, okay, because the effect of the plus and minus, there's zero. So, 1,200 on delivery equipment and 800, we still have a total value of 2,000 on our assets. On our owner's equity, it's still 2,000. So your equation is still good, still balanced. Purchase delivery equipment on account. Next person. Now let's test. Kathleen. So what two accounts are affected on this number?
The assets.
Yep. Which asset? Okay. What's happening to my cash? Is it cash? Is it cash?
Or no account.
Okay. Accounts. So when we say on account, what type of account is that?
Accounts receivable.
Not receivable, payable, because we owe, right? So this should be accounts payable is what type of account? Liability. So that liability account, under liabilities, it's increasing, 900. So a liability is increasing, what else is happening? Two accounts. So we did one, the asset, not cash, the delivery equipment, right? So you're buying an asset for the company, the delivery equipment, $900, and your liabilities is also increasing by 900. So my accounting equation is still balanced. Asset is increasing, debt is also increasing on the other side of the equation. Okay, so no cash was exchanged in this example. These are your two accounts that are affected. Both accounts are increasing. So our accounting equation is still balanced. Okay. So here's the effect. Cash, no change. Our delivery equipment has a higher total now because we had 1,200 before plus the 900 that we just did. So your total assets is 2,900. And what do we have on the other side? Liabilities, the new 900 that we just did, plus the capital that was already there. So your liabilities plus owner's equity is 2,900, which equals the assets. So we're good. Now we're making a loan payment on that equipment loan. So, Alan, what two accounts are affected?
I'm gonna guess.
Yes, go ahead and guess. Better to make the errors in class than on your homework or on your test or your quiz.
So is it asset? With cash asset?
Cash asset, yes. So what's happening to my cash?
Okay, so you're increasing.
Decreasing. So your cash account is decreasing by 300. What else is decreasing? Yeah, the debt. Remember, you're making a payment on your loan. So accounts payable will decrease. So we have cash decreasing and we have a liability accounts payable also decreasing. So we now have a balanced transaction, right? Because this side of the equation is just decreasing, that side of the equation is decreasing. So what's the new total? Cash is down to 500, right? 800 minus 300 is 500. Delivery equipment is unchanged, so now your new total for assets is 2,600. On the other side, your liability has decreased by 300, bringing your balance to 600 plus the 2,000 owner's equity, so 2,600. So still balanced, right? Good? All right, so this is what I was trying to tell you where my class was getting confused. Owner's equity. So besides the different accounts in owner's equity, so revenue, there's different revenue accounts. There's sales, there's fees earned, there's service fees, there's rent revenue. There can be a lot of different revenues that a business has, depending on the different revenue streams. Then we also have investments. Whenever the owner puts money into the business, that's an investment. These two increase owner's equity. What decreases owner's equity? We have the expenses, and there's lots of expense accounts that businesses have. They can have utility expense, they can have advertising, they can have wages, insurance. So there's a lot of expense accounts. Expenses decrease owner's equity. What else decreases owner's equity? Owner's drawing of money from the business. That decreases his value in the business because he's pulling it out. So these two decrease, these two increase. Yes.
What are the revenues again?
Okay, so examples of revenue accounts, if you are a retailer, they normally say sales is the name of the revenue account. In this example, for the delivery business, they might say delivery fees is their revenue account.
I see.
If
Sounds
I'm
like
a
income.
lawyer, I might call my lawyer fees earned.
So
So,
it's like income.
yeah, it's income.
Okay.
Okay, so different companies have different account names for their revenue streams. Okay? So, let's go on. So, one of the key concepts of revenue is when you earn it, you have to recognize it. Okay? What do we mean by recognize it? It means that even though they don't pay you in cash, did you do the job? Yes. Did you provide them with their goods? Yes. So it's revenue, okay? Even though you haven't been paid. That's why we have the AR account, because it shows that you did a job. The only thing is your customer hasn't paid you yet. Okay, so recognize when earned. Okay, as long as you do the job or you provide them with a service, it's considered revenue, even though you haven't been paid. So revenues can increase both the assets, cash or accounts receivable, and it also increases owner's equity. Okay? Okay, remember revenue increases owner's equity. So here are some examples of revenue accounts. Consulting fees, if your business is into consulting. If you have interest at your bank, that's interest revenue. And rent revenue if your business rents out space. Okay? So these are all examples of revenue accounts. So in a restaurant, they might have, well, they call it sales too, right? In the restaurant? Yeah, or beverage sales, they might separate out food sales from beverage sales. Okay. Expenses. Expenses decrease your assets, or it can increase a liability. And when you have an expense, the decrease in assets or increase in liabilities is because whatever you're doing is in the effort to produce revenue for your business. So we need to have separate accounts for every type of expense. So expenses decrease assets or increase liabilities, but always caps decrease owner's equity. Okay? So here's some example of expense accounts. So we have here supplies consumed. Because remember, under the assets, we have supplies. When you first buy supplies, it's brand new. It still belongs as an asset. But over time, you're going to use those supplies. And the way it works in businesses is, the way they track the supplies used is they go into their storage cabinet, their supply cabinet, and they do an inventory of what they believe is left in that cabinet. They might say at the end of the month, we have $300 worth of supplies. So if you started the month with purchasing $900 worth of supplies, you're now saying it's $300 at the end of the month. What did you use up for the month?
$600.
Yeah, the difference between the two. And then you're gonna do an entry for supplies expense, okay? And then taxes. All right, so net income. Net income is the difference between revenues minus your expenses. When your revenues are greater than your expenses, you have net income. Okay, so in this example, we have a tax service business. They earned $6,000 worth of income, and their expenses for the period were $1,500 for rent, $500 for supplies, and $3,000 in salaries. So your expenses total $5,000. So you have net income once you do the math, right? So this is a net loss. In the net loss, your expenses exceed your revenues. So in this example, we have a loss of $1,500. And in many businesses, especially new businesses, it takes a while before their revenues exceed their expenses.
Is it because they expand too quick?
It's not really that they expand too quickly, it's more like
Startup costs.
startup costs. You have a lot, like a new business has to buy things all the time as they're generating whatever it is that they need for their business. And it takes a while to develop a customer base that's loyal, that'll keep coming back, right? So,
Advertisement.
and then you really typically spend more in the first 2 years of your business. Sometimes longer.
So if you have a business and you have accounts receivable and you count that as revenue, but the people that owe you money don't pay you that money, and then you start like going under because you had, it's like,
Okay.
it's like imaginary
So
money.
that is why you have to be very selective who you allow to buy on credit with your business. National doesn't do it to everybody. I'm sure that before they say we're good to go with your business, they're gonna ask you, I need you to fill up an app, kind of like a bank does, an application so they know how long you've been in business. And if they see you're a new business, they might not give you 30 days to pay. They might say, I'll give you a week just to help you get along. And they might limit how much you can purchase initially. Maybe they'll cap your allowable purchase to $500, and then once they see you're paying well, they'll say, okay, next time this customer buys, and that's how a small business should work. They shouldn't just take on a client and say, this client, especially if you don't know your client, you have to be also a little bit mindful of your customers who are asking you to provide work for them, and can they pay me?
It's kind of like when you apply for a credit card, you do a background check to see if you.
Yes. Yeah, businesses do it all the time if they're gonna extend that credit to their customer. Okay, so we have another concept. So we learned business entity. Now we have the accounting period concept. So this is the concept that income determination can be made on a periodic basis. It can be a month, a quarter, a year. But any accounting period of 12 months is considered a fiscal year. Okay. So, any questions on the accounting period? Nope, makes sense? Okay, withdrawals. So a withdrawal, we understand, is when the owner takes out money from the business for his personal use. And it can be cash, or it can be assets that the business has. What a withdrawal does is it reduces owner's equity, plus it reduces your asset, because you'll either take it out as cash, or you can say, I need some supplies from your supply drawer, and empty you of all the paper that your business has, or whatever it is. So whatever it is, we're gonna consider this a drawing. Okay. So let's look at another business transaction. Rohan performed services and received $500 in cash. So
I'm kind of lost, but I'll try.
we'll try. Guess what two accounts would be affected by Rohan performing services of $500 in cash?
So he increased, right?
What's going to increase?
The profit?
Not the profit. Think of the accounts first. What two accounts are affected by this transaction?
Is it assets?
It's an asset is the overall,
Cash.
but there's a specific cash is the other specific account. So what's happening to my cash account?
It's increasing.
Yes, your cash is increasing by
500.
500. So what's the other account that's affected by this?
Is it liability? No?
No, because it says perform services. What does it mean by when you did a job for someone? Revenue. So your revenue account, which is under owner's equity, in Rohan, I think they're going to call it delivery fees. Okay. So yeah, they use it delivery fees. So their owner's equity account revenue is called delivery fees. So what's happening to my delivery fees? Is it increasing or decreasing? increasing. And what's happening to my cash?
Increasing as well.
So will my accounting equation be balanced? Yes, right, because assets are increasing and owner's equity is increasing. Okay? So here is the breakdown. So your assets now is 3,100. And on the other side, we have a new account called delivery fees 500. So it's still 3,100 on the other side. So still balanced. All right. Next example. What's your name? Allison. Rohan paid 200 for office rent.
Okay, so that would be an expense, right?
Yes.
And that would be a negative cash asset.
Yep. So
Um,
cash is decreasing 200.
So his, equity would be decreasing.
Perfect. And what's the name of my expense account for office rent?
Expense for rent, or rent.
Or rent expense? Yeah, that's it. Rent expense and cash. So will my accounting equation still be balanced?
Yes.
Yes. Cash is decreasing and owner's equity is decreasing. So, what's tricky is they say my rent expense is increasing because the expense account is increasing, but what's the effect on owner's equity? Decreasing. Okay, so that's the tricky part when you start seeing, why is my expense account increasing? Well, it is increasing, but
The
how does it
negative
affect owner's equity? That's the negative part. Okay? That's the part. Alright, so will my accounting equation be balanced? Yes. So here's the showing, right? 200, so now it's 2,900 for my assets. And on the other side, you have 600, which is the accounts payable, plus the capital of 2,000, plus the revenue 500, and the effect on owner's equity is a minus 200. So that's why it's 2,900. Okay? Okay.
D.
D. Okay, go ahead. Rohan paid $50 for phone service.
So the assets went up by $50.
Paid.
Oh, paid, sorry. So it decreased by $50.
Which asset
That's
account?
assets.
Which account name?
Equipment. Or
What do you use to pay your phone bill?
utility.
Cash. Big C.
Oh.
Okay, cash or checks. Okay. So cash is decreasing
Yes.
$50, and what's the other account that's affected?
Accounts payable.
No. Expense.
Oh, the expense.
Expense. So they call their phone expense. Okay, so phone expense is an expense account. So your expenses are increasing, but the expense of expense is what's happening to owner's equity.
Decreasing.
Then cash is decreasing. So we're still balanced. That's what we're showing. So notice that the assets keep decreasing with each payment. It's on this side of the equation. So notice here the expense plus the 50, but this 250 decreases my owner's equity. Alright. We did this row. What's your name? Maria. Okay, Maria. Rohan paid $600 of delivery services on account. Performed. Performed is a keyword, so what does that mean? What accounts are affected by this? Accounts receivable, yes. So what's happening to my accounts receivable? Is it increasing? Yes. By 600. What's the other account that's affected?
Revenue.
Yes, revenue. So what's happening to my revenue account? Increasing, and how's that affecting what section of my accounting equation? No,
Owner's
remember?
equity?
Yes, owner's equity. What's happening to my owner's equity with revenue?
Going up.
It's going up. So is my accounting equation balanced?
Yes.
Yes, right? Because even though we got no cash, assets are going up, and owner's equity is also going up. So here is our new column for my AR. And here is my revenue. Okay, so 34, still balanced. Next, purchase supplies for $80 cash.
So assets, cash will decrease.
What did you say?
Decrease, cash, asset, cash.
Okay, so asset cash is increase or decrease? Decrease, yes. Cash is going down because you're buying supplies for cash. Anything else? What's the other half?
Supplies.
You just bought it. No, you just bought it.
Oh, you just, oh, okay.
You just purchased it, right?
Yes,
So it's still
under asset.
yes.
Okay.
Okay, what's the name of the asset account? Supply. So we have everything happening on the asset side. We have cash decreasing because you bought it for cash, and then you have another asset increasing by $80. So my accounting equation is balance. So all the changes happen here. So still 3450 besides notice minus 80 on cash plus 80 on supplies. Okay, next. G. What happens? If Rohan paid for an 8-month liability insurance policy with $200 cash, insurance is paid in advance and will provide future benefits. So right now we're just paying for this service. So what are the two accounts that you think are affected by us buying this insurance?
Cash,
What's happening to my cash?
decrease,
Decrease by,
to,
yep,
and, liability.
no, okay, so, what, oh, you're saying liability, because it's liability
Because it's there.
insurance, yeah. Not
Almost definitely,
no,
no.
asset. So insurance, when you first buy it, is an asset, because no time has lapsed. Remember, insurance is spread out over a year, every you use it up, right? So when you first buy it, it's an asset. And they normally like to call it prepaid insurance, because that's how we pay for the insurance. You prepaid and you use it, and then you're gonna expense it at the end of the month or the end of the quarter, is how the business is doing. So, right now, you're just gonna record cash decreasing by 200, and then you're gonna show, prepaid insurance 200. Increasing. So again, everything is happening where? On the asset side. Okay, so there we go. So still balance, no change on our equation at all. So put everything on the asset side. Next. With me. Without my assets. Cash is increased, yep. No? Okay, because for services recognized, so where do we put money that hasn't been paid for, to our businesses? Accounts receivable. So in this example, everything is happening again on my asset side. You have an asset, cash is increasing by 570, and you have your AR, and you know it's AR because it says for services recognized in an earlier, so it's not revenue anymore. You already recognized it as revenue back when you did the job. Now you're actually getting the payment. So that's why it's said that way. Okay, so cash and accounts receivable.
So is that kind of like a gift card, like you were talking last
Yeah.
week?
Yes, the gift card, exactly. So they put it as a, but they don't put it as a AR though. It goes as a liability under. So we'll learn about that later. Okay, so everyone's clear on this example. So everything is balanced, okay? No changes on that side of the equation, it just happened here. Cash decrease, prepaid insurance. Alright, next person.
This is the same example.
Then we go backwards?
Yeah, you went, yeah.
Oh man, sorry guys. Yeah, sorry. Wrong button. Okay, here. Purchase delivery equipment for 300. Okay, so this one affects more than 2 accounts.
Like,
Okay, so you get this one. What's your name? Ira, okay, Ira.
Accounts payable
Yep,
and cash.
okay, that's two. There's three on this one.
Let's see, delivery equipment, that is, wait. Delivery equipment, revenue, no. Liabilities,
No, assets, remember? Everything the business owns is an asset, so the equipment is an asset.
That's
So
one.
they just bought it. So what's gonna happen is, I'll write on the board. So, let me erase this part. So in her example, they bought what? Delivery equipment? And that is an asset. So our delivery equipment asset is increasing.
Is that under expense?
Why? How much is the equipment they bought? We don't know yet. Okay, we gotta do the math on the other side.
1,500, 3 plus 12, right?
Yes, okay, so 1,500. So that's the value of what the delivery equipment costs. And how did they pay for that delivery equipment?
With their assets?
So what's happening to my cash account?
Minus
It's decreasing by 300. And what else did they do?
They put 1,200
On the account.
Accounts payable, which is our liability. So our accounts payable and liabilities are increasing. So will my accounting equation still be balanced?
Yes.
Yes, right, because 1,500 minus 300 is 1,200, so the assets change by 1,200, and that side is also 1,200.
Okay.
So there are your three accounts. There's the breakdown of that. All right, who's next? Joseph, okay. Pay your part-time employees. For what account? No.
Expense.
So first, what are you paying out? How do you pay your employees?
What cash,
For cash. So cash is what?
assets.
Asset, which is what? Is it increasing or decreasing your cash?
Decreasing.
Decreasing, right? So decreasing cash. And then when you pay your employees their wages,
Owner's equity.
that's an expense. So expenses affect what account? No.
Equity.
Owner's equity.
Equity.
Remember, owner's equity is the one where we have
The
that wonderful
profit.
pie that went like this, owner's equity is here. And some things decrease owner's equity and some things, increase owner's equity. What increases owner's equity?
Profit.
Revenue. And what else?
Net profit.
Investments by the owner. And what decreases owner's equity? Expenses.
Second one, withdraw.
Withdrawing.
so because it's an investment on the employees, would it also,
Well, it doesn't say their investment in employees.
an employee's deal?
Yeah, because they're the ones who bring
The
in the customers.
benefits, some people, okay, that's not in our scope in this chapter. We're gonna get there. Okay, but sometimes businesses do invest in their employees, like providing educational, stuff, but business normally needs. Okay, so this will be expense, right? And you know what accounts will be affected? So it says your expense account is increasing, but what's my effect on owner's equity? Decreasing. So will this make my accounting equation balance? Yes. Okay, so still balanced. Alright. Merriman. Oh, Erica. Receives delivery fees as follows. So this is another one that affects more than two accounts. So let's start off with cash. Okay, so what's happening to my cash? Erica? What's happening to it? It says, is it increasing or decreasing? Yeah. The decrease is just receipt. Increase, right? is you're receiving cash, 430. And then what about this? What's the account that's deducted? Say 620 on account. Accounts receivable. So what's actually happened is they did a job. The customer can't pay everything for the job. They only pay part in cash, and then part I'll pay later. And that happens a lot. Some people get their car fixed and can't pay all the costs now, so they pay some, and then the rest is on account. If AK will do that for whoever your car is. But it also happens in businesses. National, they might say, I'll pay a little bit and the rest will be on account. So, receive delivery fees as follows. So how much income did they generate?
1,020.
Yeah, so we have to add the 620 plus the 430, because that's what they
I'm sorry,
provide.
1,050, yeah.
Okay, so that would be your delivery fees. Okay, and then you would record cash, the 430, and the other would be your AR, the other part, revenue. And then the delivery fees is your revenue, the total of the services provided. Okay, so this one's a little tricky because you have a lot of things going on, but you're gonna find customers who do this kind of, you do a service for them, I'll pay you a little bit now, because they feel kind of bad, so they'll pay a little bit today, and then the rest it's on later plan. So your cash is increasing, your account receivable is increasing, and your revenue is increasing, which increases my what? Owner's equity. Revenue falls under owner's equity. So are we balanced? Yes, right? So you'll notice there are your two increases. Our total assets now is 5,050. And this side, there's my revenue. And again, it brings it up to 5,050. Okay, next number. Tiffany? Marielle, okay. Rohan withdrew 150 for personal expenses. What two accounts are affected?
The asset cash
Yep. Is it decreasing or increasing?
decreasing,
Decreasing, yep.
and then,
What do we call it when the owner?
is that a withdrawal?
Yes, or
That's the
drawal.
owner's,
Under owner's equity, and it's, what does it do to owner's equity when the owner withdraws? Decreases owner's equity. Okay, so here is your two accounts. Drawing is increasing, your cash decreasing. But what's happening to owner's equity? Decreasing. Okay? So drawing increase, cash decrease, but owner's equity is decreasing. Okay, so just like expenses, drawing and expenses decrease owner's equity. So are we balanced? Yes, right? There's the 150, earning assets 4,900. The other side of the equation, we have the drawing, but notice that drawing decreases the owner's equity. All right, so we're done. Everyone got an example transaction to do. We have enough people for every transaction. Now, your accounting period is done. It's the end of the month. Your owner wants you to prepare the financial statements for the business. So the financial statements are prepared in the olden days. You have to prepare them in a certain order. You always start with the income statement first, then the statement of owner's equity, then the balance sheet is third. Nowadays, with computerized programs, prepare reports, okay? And you can choose what reports you just click in any order that you want, and it'll be correct if your data is correct. Okay? All right. So these are the three we're going to learn about in this chapter. So the income statement shows us if your business is profitable. Whenever you hear that word profitable, they're always looking at revenues minus expenses. That's what is foremost in every owner's mind. Revenues minus expenses. And they're looking at a period of time. Some owners want to know daily. Okay, but it's kind of hard to do because a lot of your expenses, people record expenses daily. No, they don't. they don't pay their employees daily, they don't pay their power bill daily, usually once a month. So it's hard to kind of figure out, an income statement on a daily basis. A lot of businesses do it more on a monthly basis. Okay, so what we're doing in our income statement is your revenues for that period you're looking at. You're gonna look at only those revenues for that period. And your expenses that you're gonna subtract are only for the matching period. So if I'm looking at the month of January, I'm only gonna look at income from January and expenses from the month of January. I'm not gonna include February or December's, okay? Because your revenues must match your expenses. Actually, it's a concept that's not on your slide. It's called the matching concept, okay? But just keep that in mind. Revenues minus expenses. Another name for an income statement is profit and loss statement or operating statement. So when you prepare your income statement, just like with any report that you do, you want to let the reader know what are you preparing and who is it for. So you always start with the business's name as the title, and then you put, what are you preparing? So an income statement. So there's the report name, and then the date. So when you do an income statement, remember, it's not covering only one day, it's covering a span of time. So we like to say the time period covered. So you would say for the month ended, so we know that it's just for the month of June. Or you might say for the quarter ended, then we'll know that it's like from that quarter, from the first part of the quarter till the end of the quarter. Okay, or that some businesses like to go for the month, or it'll say from January 1st to December 31st. So we know it's for the year. Okay, so those headings are necessary. And then when you start filling up your form, this first part of the form is used for listing items that you're going to be listing on these other two smaller columns. So this first middle column is used for totals. And then this last one is if you have more than one account. So if your company has more than one revenue account, you would put delivery fees, sales, and then you'd write the two totals for those items here. And then you put the total on this furthermost column. Same goes with the expenses. In this case, because they only have one revenue account, I'm just going to put delivery fees, the furthermost column. Your expenses, though, will be expenses, and we're going to list the expenses, and then the expense dollar amounts will be in this inner column. So here it is. Okay. And then the last column is for the total. So what this totals to, 900. So whenever you are totaling a column, you're going to put a solid underline. Since you guys are doing all your homework online, I guess we don't need to worry too much about the solid underline. In the olden days when my students used to write it, you get points deducted on your assignment for not having to do it. Okay, and then here's your total. So what's this figure going to be? Is it net income or is it a loss?
Loss.
So look, your revenues are greater than your expenses. Net income, right? Because as long as your revenues are greater than your expenses, you have a net income. And the difference will be listed here. So that is 1,250. Okay? And normally we double underline your final total. Okay? So now that we've prepared the income statement, we need this net income figure because it's reflected on our statement of owner's equity. So that's the next statement we're going to prepare. So again, it covers a specific period of time, and you use your net income from that income statement. So when you prepare your income statement, you always start with, of course, the headings. So it doesn't show the headings in the slide, but after the headings, you start with your beginning capital for that period. So if you're looking for the year, this would be your capital at the beginning of the year, or in this case, the beginning of the month of June. So this is how much capital they had. And then what happened during the month? What causes your capital to change? So this is where we look at Your capital, we have starting capital. Did the owner make more investments in the company? In the case of Rohan, there was no more investments that he made, so we're not gonna have anything there. So this revenues and expenses is reflected in what? That net income. So that's why net income is written next, okay? Did the owner do any withdrawals? Yes. So the withdrawal will be listed next. Less withdrawals for the month of June. So 1250 minus the 150. This is your change in your capital. So this will be labeled over here, increase in capital. So increase in capital, 1100. This 1100 gets added to the beginning capital, bringing our ending capital to 3100. Okay? So now that we've completed the statement of owner's equity, what's the third financial statement we're going to prepare?
Balance sheet.
Balance sheet. So the balance sheet is prepared, and we're going to use this capital to be our capital figure on the balance sheet. So notice that the titles, so the name of the company, what you're preparing for the month ended. The balance sheet is different though. The balance sheet doesn't cover a period of time. It's specific. It's on a specific date using the balances in cash, your ending cash figure on the end of the month or whatever date you're looking at. What's your ending figure for your accounts payable? Okay. So the other thing that we're showing on the balance sheet is that your accounting equation is balanced, because with the balance sheet, we show the assets, we show the liabilities, and we show the owner's equity. Another name for the balance sheet is statement of financial position or statement of financial condition. So here is the three headers for the balance sheet. Company name, what are we preparing? And notice the date, a very specific date, because they want to know the balance in those accounts on that date. So, cash, this is our ending balance on June 30th. This is the balance for AR, and so on. So the total of our assets is 4,900. And what do we have for our liabilities? We have one liability account called accounts payable. This is its balance. And here is capital straight off our statement of owner's equity, 3,100. When you add the two, your total liability and owner's equity are equal. So this format of the balance sheet is called the account form. In account form, when you do your total assets and your total, this has to be on the same line. Okay? And it shows that we're balanced. Another format is it doesn't show us the report form. The report form lists your assets first, liabilities right under, and then owner's equity on the bottom. Like the report. Okay. This one is side by side. So this is called account form. Alright, so objective 6 on chapter 2. Define the three basic phases of the accounting process. So there's three phases. There's the input stage, there's the processing, and the output. So when you are looking at those business transactions that are coming into your organization, this is your input, okay? Your processing is the thinking part. You have to determine, just like what we did in the examples, classify accounts, determine the increase or decrease, and then enter the transaction and make sure that it balances. The output are the reports, the financial statements. So we have our financial statements. So here's our income statement, and it shows you that after you prepare your income statement, this net income is necessary to complete our statement of owner's equity, because there's a section for the net income. And then, when you complete the statement of owner's equity, your ending capital feeds into our balance sheet. Okay? Working capital is the owner's equity. The lecture is short on this one.
It was?
So input is the
Did you grab all?
whatnot. So you are
Yeah.
distributing-
No, I know, yeah, I can. I do it
One
for
thing
my
about
other classes.
accounting that I want to stress to you, those items that you're inputting, we
Yeah.
call that a source document. And you all know about source documents, right? What do you have to do with it?
Save it.
Save it, file it. So all those receipts as invoices or whatever